Dave Sekera, though, he's chief U.S. market strategist for Morningstar, who rates this sector underweight. So, David, let's reconcile your view with the earnings, the fundamentals that are driving these stocks higher.
Well, and I hate to be the one that puts a damper on a day that's as strong as it is today, but when I look at the tech sector overall, it's currently trading at a 9% premium to a composite of our fair values of those stocks that we cover. And in fact, the last time it's been this overvalued in our mind was back in January of 2022, and we of course know what happened, after then. So again, with the Magnificent Seven, at this point, I think most of these stocks have run their course at this point. They're either fully valued, close to full value, some like Apple, are overvalued. And I think in the tech sector, you really need to start looking away from the Magnificent Seven, looking for some of these other stocks that have been overlooked and remain undervalued.
Okay, you keep using that word sort of overvalued. And one thing that I struggle to get my head around is what is value when it looks like the market in front of you is sort of this open sea. It's hard to handicap the growth. It's been touted as sort of the next wave of the internet. How do you put a multiple on that?
Well, we don't. So we are long-term investors. We do a full discounted cash flow analysis. We model out how much cash flow we think a company is going to generate, each individual year over the course of its lifetime. We use our weighted average cost of capital in order to take the present value to come up with what our intrinsic value, of that company or that stock is today. With some of these, companies, I think trying to use multiples is almost a fool's errand, to some degree. So let me just kind of give you one example. So Meta is probably the one right now that we think is too far overextended. Our fair value is $400 a share there. But I don't think our assumptions are overly conservative. So we're looking at 16% revenue growth this year. We're looking at a 5-year compound annual growth rate for revenue of 11%, operating margin of 37% this year, expanding to 41% over the next 5 years. And I would just compare that to the historical average, has been 33% over the past 3 years. So when we put those numbers into our model, we do think the stock, as much as it's up today, is probably getting to be overextended and moving into that overvalued area. And I'd be careful, with that stock over the next couple months, next couple of quarters. So we do think that the rate of economic growth here in the U.S. is going to slow. So I do think that their digital ad growth is going to slow in relation to the economy. And I'd also note too, they're going to be up against some very tough comps, in the second half of this year.
What's that saying? The markets can stay irrational longer than you can stay solvent. There is an element of so much momentum, so much influence for that it has on the markets. How do you think about how long it might take for investors to wake up to, okay, what should be my valuation here?
It's always hard to know in the short term, what the market's going to do, on any individual day or weekly basis. But again, with that long-term view, I think you have to position your portfolios, to take advantage of those areas that the market, might be overlooking, and make sure that you start, underweighting those areas as they, move, further and further upwards. And I think the Magnificent Seven is a great example of that. So beginning of last year, 6 of those 7 stocks were rated 4 or 5 stars. In our terminology, that means that they were either undervalued or significantly undervalued. At this point, only Alphabet is still undervalued. A couple of these stocks, NVIDIA, Apple, Meta, are beginning to move, too far into overvalued territory. So I think now is a very good time. Take some of the profit that you've made over the past year in those stocks and look to reallocate that, in other areas, different areas like value stocks, small cap stocks that have lagged, that we see, much better opportunities today.
Let's talk about that. I mentioned we're going to be diving into results from Chevron, Exxon. Is energy a sector that you would think could benefit from a rotation?
It is. It's a sector that really has lagged, the rest of the market over the past years. We see a lot more opportunities in energy today. So that sector overall trading at a 9% discount to our fair value. But there's a lot of companies here that we haven't seen, this kind of value for over the past year. So Exxon is currently rated 4 stars, trades at a 20% discount to our fair value of 123 per share, pays a nice hefty dividend yield of 3.8%. In our view, it's the most undervalued of the global majors. And when I take a look at our model, I'd note, we are projecting production and margin expansion through 2027. So I do think that's one that, investors should be looking at today.